It was a quiet Tuesday afternoon for 69-year-old Carol from Knoxville, Tennessee. She was a lifelong careful saver, paid every bill on time, kept a steady balance in her personal checking account, and 2 years prior, she added her adult son as a joint account holder. Her arthritis made trips to the bank branch painful, and she believed adding him would simply make bill payments and emergency banking easier. Everything looked perfectly normal until that morning she logged into her online banking and saw $44,000 of her life savings was completely gone, withdrawn legally by someone connected to her son. When she called customer support at her bank, representatives told her there was nothing they could reverse. Under the signed joint account agreement Carol completed years earlier, her son held full equal legal ownership over every dollar inside the account, and third-party creditors had every right to seize the entire balance to settle his outstanding civil judgment. Carol's story is far from rare. Every single year across the United States, joint account-related financial exploitation costs American seniors $280 billion total, and 70% of all victimization comes from people the elder knows and fully trusts. In the most recent full reporting year, financial regulators logged 88,000 confirmed senior exploitation cases, with an average individual loss of $35,000. These losses do not stem from hackers or unknown scammers online. They come from people whose names sit officially on your joint bank paperwork, and banks will never volunteer to warn you of these life-altering legal consequences when you sign up for shared accounts. Today, we break down 3 major updated joint account rule changes rolled out by financial institutions and state legislatures over the last 2 years. Changes buried in revised account agreements sent via generic mailers, most seniors never open, with 0 mandatory follow-up phone calls or in-branch staff walkthroughs to explain the risks. Banks frame joint ownership solely as a convenient tool for elder care and end-of-life asset transfer, because joint accounts generate consistent deposit balances, automatic fee revenue, and minimal internal compliance overhead for financial providers. They hold no financial incentive to explain what equal legal co-ownership truly means under federal banking code and state probate statutes. The first critical rule update covers survivorship clauses, and this single clause can completely erase every instruction written inside your signed, notarized last will and testament. The vast majority of shared senior bank accounts are structured as JTWROS, joint tenancy with right of survivorship. The original core rule has always remained the same. Upon one account holder's passing, the surviving named joint owner automatically receives 100% of the full account balance instantly. No probate court involvement, no waiting periods, no additional paperwork required. That foundational piece of law has not shifted, but the updated language inside modern bank contracts has drastically strengthened survivorship priority, making it irreversible against estate planning documents. Thousands of family disputes unfold every single year from this exact loophole. A parent writes a fully witnessed attorney-drafted will splitting all savings equally across 3 adult children, yet only one child is listed as a joint account holder. When the parent passes away, that single joint heir legally collects every dollar held in the shared account, and the other siblings have 0 legal grounds to contest the transfer. Consumer Financial Protection Bureau. Dataless conflicting joint account survivorship language and will provisions as one of the fastest-growing sources of costly, multi-year estate litigation nationwide. Even if you drafted your will last year, your decades-old joint account signature card with updated bank contract terms overrides every estate plan you created. Banks are legally permitted to update all account terms unilaterally, only required to send a single written notification buried inside monthly statements or mass seasonal mailings. You are bound to the new legal language, even if you never signed an updated agreement copy, and your will cannot act as a legal defense against the survivorship transfer written into your joint banking contract. The second, far more damaging rule, expansion widens creditor access to full joint account balances, and this risk activates long before anyone passes away. Revised state asset seizure laws and updated internal bank compliance policies now grant nearly all types of creditors full authority to target 100% of funds held inside a joint account, regardless of which depositor originally supplied every dollar stored there. Your natural assumption that money you alone earned and deposited stays protected from your co-owner's personal debt carries zero weight under current financial regulation. We return to Carol's real-world example to illustrate this clearly. After her husband passed away, Carol's adult son convinced her to add him to her primary checking account to manage monthly medical and utility bills. The account held her decades of Social Security benefits, monthly pension deposits, and 31 years of carefully accumulated personal savings. Later, her son's small business partnership collapsed, and his former business partner won a large civil monetary judgment against him in state court. Creditors filed a levy directly against Carol's joint bank account and seized the full $44,000 balance in one single action. Carol had done nothing wrong. Every dollar in that account belonged solely to her. Yet under joint tenancy legal structure, her son's personal creditors possessed identical legal claim rights over the entire shared balance as he did. The lengthy legal appeals process took 8 full months, and Carol only recovered a partial fraction of her seized savings after exhausting court filing fees and legal consultation costs. The Internal Revenue Service operates under identical collection rules laid out in Title 26 U.S. Code. If one joint account holder carries unresolved federal tax debt, the IRS can levy the complete joint account balance to satisfy outstanding tax liabilities. Student loan servicers, medical bill collection agencies, and civil judgment holders all benefit from these expanded seizure provisions adopted across nearly every U.S. state within the last 3 years. This rule shift also creates catastrophic Medicaid long-term care planning complications. When you submit an application for Medicaid nursing home coverage, state agencies conduct a mandatory 5-year financial lookback audit of every asset transfer and account ownership change you completed. Adding any family member as a joint owner counts as a partial asset transfer for Medicaid review purposes, and every dollar held within that joint account may be legally classified as belonging to both listed owners for eligibility calculations. Many seniors add adult children for simple bill management without understanding the 5-year look-back penalty rules, only to face multi-month benefit waiting periods or full permanent disqualification from long-term care aid exactly when they require nursing support most. Every dollar sitting inside a joint account carries full exposure to any unresolved debt, legal judgment, or federal financial obligation attached to your co-owner. And larger balances only make your shared funds a higher priority target for collection agencies. The third revised joint account rule expands the window for financial exploitation before banks initiate formal dispute resolution reviews, creating dangerous gaps. Bad actors can fully exploit to drain your life savings before intervention can happen. Financial institutions have adjusted internal fraud monitoring thresholds and rewritten customer dispute resolution timelines inside updated joint account contracts, creating a far wider window where a co-owner can withdraw massive sums and empty the account entirely before the primary holder can freeze activity or file a formal dispute. Bank anti-fraud software only flags unusual transactions coming from external, unauthorized outside parties. Any withdrawal, wire transfer, or cash out completed by a named joint account holder automatically registers as an authorized transaction inside bank systems, triggering zero fraud alerts or customer outreach. Exploitation by trusted family members remains completely invisible to standard banking surveillance tools until every dollar has already been removed from the account. Under older joint account contractual language, co-owners disputing unauthorized large withdrawals could trigger an official internal bank audit within 10 business days. Newer revised account agreements reclassify these conflicts into contractual gray zones, citing equal shared ownership as a full legal defense for the bank to delay or deny intervention entirely. Formal resolution timelines now stretch to 90 days or longer across most major national banking chains, and thousands of CFPB consumer complaints document cases where banks outright refused to mediate joint account fund disputes, citing the co-owner's full legal right to access and withdraw all shared assets. 70% of recorded senior financial exploitation incidents involve trusted relatives draining joint accounts, matching tens of thousands of annual complaints filed with federal consumer protection agencies, with average total losses hovering right around $35,000 per victim. This expanded dispute window creates an even greater risk for elderly spouses experiencing early memory loss, paired with sophisticated telephone fraud schemes that target joint checking accounts. Scammers now utilize voice mimicry technology and spoofed official caller ID displays to impersonate bank fraud department staff, convincing the cognitively impaired joint account holder to wire massive lump sums into fake secure holding accounts. Since both spouses hold full joint ownership authority, the uninformed partner has zero ability to pause or reverse the transfer mid-process, and the bank's automated systems mark the wire as an authorized owner-initiated transaction with no warning outreach sent to the secondary spouse. The combination of longer dispute processing timelines and instant electronic fund transfers makes joint accounts the highest-risk financial tool for elder fraud victims in this generation. Now that we have covered the 3 devastating updated joint account rules currently endangering seniors' life savings nationwide, I will walk you through 5 actionable, zero-cost steps you can complete this week to eliminate all joint account exposure risks while retaining convenient bill management support from trusted family members. Step 1. Request a full copy of the currently active joint account contract paperwork for every shared account you hold at your bank branch or via official secure online banking messaging. Do not rely on the original signature card you signed years ago. Financial institutions regularly update account terms with minimal notification requirements, and you need to review the exact current survivorship language, creditor levy provisions, and dispute resolution timelines active on your accounts today. Step 2. Compare every joint account's survivorship contractual wording, line by line, against your signed, notarized last will and testament. Schedule a low-cost, fixed-fee consultation with a state-licensed elder law attorney or local legal aid office to resolve conflicting asset transfer instructions. A single 1-hour consultation can prevent years of expensive sibling probate litigation after your passing. Step 3. Ask your bank representative about durable power of attorney for finances as a fully risk-free replacement for joint account ownership. A durable financial POA grants your trusted adult child limited legal authority to pay bills, manage routine banking tasks, and assist during medical emergencies without transferring any partial ownership of your funds. One critical difference separates POA from joint ownership. 100% of your money remains legally yours at all times, fully shielded from your designated agent's personal creditors, tax debts, civil judgments, and divorce proceedings. Upon your passing, POA legal authority immediately terminates, and your assets distribute per your will or payable on death beneficiary designations with no automatic full transfer to your designated helper. Your bank will also offer payable on death, shortened to POD, beneficiary forms for all individual deposit accounts. POD designations let you name specific heirs to receive your savings instantly upon your passing, bypassing costly probate court entirely, yet named POD beneficiaries hold zero access rights or ownership claims to your funds while you are still living. This single dual solution of durable POA plus individual account POD beneficiaries solves nearly every risk we have outlined within this video while preserving convenient financial support from your loved ones. Step 4. Create a small buffer joint account strictly for short-term monthly living expenses, holding only enough cash to cover 30 to 60 days of regular bills. Store all your core life savings, pension rollovers, Social Security lump sums, and inheritance proceeds inside fully individual bank accounts with formal POD beneficiary listings. This simple split account structure separates convenient daily transaction access from your primary long-term wealth, shielding the bulk of your retirement funds from creditor levies and family exploitation risks, while still allowing trusted family to assist with routine monthly payments. Step 5. Research your state's official asset levy exemption rules via your state attorney general's public website. Many states offer partial protection for Social Security retirement deposits and pension income even within joint accounts, and understanding these legal carve-outs creates a critical dividing line between protecting your fixed retirement income and permanent total loss of your savings. I also recommend asking your banking provider about their Trusted Contact Designation program at no additional charge. A trusted contact is a third-party individual the bank can reach out to if staff spot unusual account activity, potential fraud signals, or worrying withdrawal patterns on your accounts. This designation never grants any money access or ownership rights to the trusted contact, only creates an extra layer of early warning protection without altering your asset ownership structure whatsoever. Beyond these 5 formal legal and banking adjustments, adopt one simple zero-cost monthly habit to catch exploitation or hidden account issues long before massive losses occur. Manually review every single line item on your full monthly bank statement. Federal regulations force banks to flag specific high-risk suspicious activity, but small, regular repeated withdrawals by a joint family member rarely trigger automated fraud alerts because the transactions fit normal authorized owner activity patterns inside bank algorithm systems. The only reliable early warning system for slow-burning financial exploitation is consistent personal monthly review of your own account activity, taking just a few minutes each month to cross-reference expected regular deposits and withdrawals against actual recorded transactions. Flag any unfamiliar transfers, unexpected large cash outflows, or recurring payments you never authorized immediately with official bank support lines using the customer service number printed physically on your bank card or mailed monthly statements, never phone numbers sent via text message, email links, or unknown incoming caller IDs. To wrap up today's full breakdown, recap the 3 core updated joint account rule changes every senior must understand to protect decades of hard-earned retirement savings. First, modern JTWROS survivorship clauses fully override all will and estate plan instructions, allowing a single joint account holder to inherit 100% of shared savings and cut other family members out entirely with no legal recourse. Second, expanded state and federal creditor access laws let judgment holders, the IRS, and student loan servicers seize the full joint account balance regardless of who deposited the money, risking total loss of pension, Social Security, and personal savings over your co-owner's separate financial mistakes. Third, revised bank dispute resolution timelines create a months-long window for trusted joint holders to fully drain your account before formal bank mediation can begin, amplified by modern instant electronic transfers and memory loss-targeted phone scams that exploit joint account automatic authorization rules. None of these 3 major rule shifts required new customer signature confirmation, and most banks only notified existing account holders via tiny, fine print buried inside mass monthly mailings most seniors discard unopened. Waiting until convenience turns into a financial crisis will cost you tens of thousands of dollars in lost retirement funds, legal fees, and permanent Medicaid eligibility penalties. Complete the 5 zero-cost protective steps we covered within this week to lock your savings away from unnecessary joint ownership exposure. Before we close this video, I want to remind all viewers that my full state-by-state senior exemption handbook, packed with official bank POD forms, durable POA checklists, joint account risk self-audit worksheets, and Medicaid 5-year look-back planning guides, is pinned as the top comment below this video. Download your copy in one click to complete a full personal financial self-checkup covering joint accounts, Social Security unclaimed benefits, FinCEN large cash deposit compliance rules, and probate avoidance POD planning in one single organized resource. If this detailed breakdown of hidden joint account risks helped you recognize critical threats to your retirement savings, hit the subscribe button and turn on all channel notification alerts. Every Wednesday, I release brand new full-length deep dive videos breaking down hidden federal banking, Social Security, and estate planning rules. Banks and government agencies will never volunteer to explain to senior taxpayers. Join our growing community of retirees learning zero-cost legal strategies to permanently shield their life savings from avoidable financial loss, creditor seizure, family exploitation, and costly probate court proceedings.